So I've actually compared basically stablecoins in one of my earlier videos about central banking to what they used to do in the 17th century in the Netherlands. For example, the Bank of Amsterdam, or you could go with actual gold, deposit gold in the Bank of Amsterdam, then get some Bank of Amsterdam deposits and trade with those deposits. I think it's very similar to that. What do you think of that comparison?
Yeah, I think there's definitely similarities. Like the basic mechanism is pretty similar. There are definitely differences with kind of blockchain technology in that it's fully decentralized. So, well, our system is at least, so that you can actually, you interact directly with the protocol on Ethereum. So this kind of system of rules kind of encoded in smart contract code that lives on the blockchain. It's kind of an automatic machine in a way. And so there's no kind of middleman or banker deciding if you should or shouldn't be allowed to make this deposit and take this loan. It's all fully automated. It's fully permissionless, so actually anybody can make that Ether deposit and draw LUSD against it, as long as they're kind of meeting the conditions baked into the protocol.
Yeah, okay. Yeah. I think that's a really good, because the thing is, like, I'm an economist, and so I love to compare this to the stuff that I already know. So that would be a bank. But you're definitely right to point out that it really isn't, because there is no middleman, right? Can you tell a little bit more about, how that then works? Because I think, I know there are also a lot of blockchain enthusiasts in the chat who definitely will think this is a piece of cake, but I think for the economics crowd, it's a bit mind-blowing.
Sure, yeah. So blockchain is basically a kind of it's a tamper-proof record of actions and transactions. And it's tamper-proof because it lives on thousands of computers around the world, and they all hold the same record of history, of the kind of like transaction history. And basically it's kind of secured by the miners. You've probably heard about these miners who mine cryptocurrency, that they actually are kind of paid to secure the network and like make it tamper-proof.
But these are the Ethereum miners then, right?
Yeah, so that's kind of the underlying blockchain technology. And then on Ethereum, it's possible to build applications that borrow its kind of trust properties. So, we've deployed Liquidity to Ethereum, and the application itself is actually set in stone, because like we've deployed the code, and that code is the same across all those machines that run the Ethereum network. And we've actually removed ourselves as owners of that code. So now there's actually no kind of admin or central controller of the Liquidity system. And so the code is immutable. It can't be changed ever. It could only kind of be changed if the Ethereum network itself is changed. So it has this kind of powerful property of borrowing the trust of the underlying network. And yeah, in doing so, that makes it, it means you can trust the code instead of trusting the operator, basically.